Are you ever confused about what APR is or what APY is? Let's ask Dan.
Take it away. APR is annual percentage rate.
Okay.
So it's the cost of money. It's usually what a loan rate works out to be. So, if you are paying 6% interest for a car, that would be your annual percentage rate. APR, 6%. Okay. That's the cost of the money to get the car. Now, when you're making a payment on a car, a mortgage, etc., it's not just 6% of the amount. It's more than that because you're also paying some of the principal.
Yeah.
On
and
the
the
thing.
Principal is?
The original amount of the loan.
Okay, so if you have a car loan for $23,000, the principal is $23,000.
Right.
And then if you have an APR of 6%, you're paying that much more money on top of it to use the bank or whatever financial institution is loaning you the money to use their money.
That's correct.
Okay.
It gets a little more complicated as you pay it because it starts at 6% of $23,000. Now, your first payment is going to have a little bit of principal to it. So now it's 6% of some number slightly lower than $23,000, right? Because your principal's down. This is called amortization. This is the process of paying down the principal. So the interest is a lot at the beginning, but it goes down with every payment, and the principal portion goes up with each payment, and that helps you pay it down faster. Okay. Towards the end of the loan, you pay more principal down.
So as you're paying your loan off, because the amount you owe is lower, the amount of interest stays proportional to whatever you owe.
It's only on what you owe.
Goes down.
It's not on what you started owing. It's just on what you owe at that point. So for the payment staying the same, which it does, the interest portion becomes a smaller portion. The principal portion becomes a larger portion. So it looks kind of like this. If it were a graph, your principal pay down is slow at first, and then the principal goes down very rapidly towards the end of the loan because most of what you're paying now is principal.
Is the principal at the end.
Right.
Because the interest is so little.
That's correct.
And the monthly amount stays the same.
Yep, that's correct.
Okay, it's like if you have an omelet and it's mostly peppers at the beginning and it's only a tiny bit of egg. And then at the end, it's like all egg and just peppers.
It's exactly like that.
But it weighs the same amount.
That's perfect. That's a perfect analogy. In fact, surprised I didn't think of that myself.
Oh.
Great. Okay.
I'm obviously the brain.
So you asked APY also.
Yes.
So APY is annual percentage yield. It has to do with the interest rate you're earning on money you have invested. So it might be in a bank account or a bond, something like that.
Okay. So I've seen this on savings accounts, right?
Yep.
It'll have like high APY or something. High APY savings account. So that's the money you make for basically lending your money to the bank.
To the bank, right.
Because it uses your money while it's there.
That's correct. They take the money, and they also borrow money from the Federal Reserve, the Fed, and then they loan that money out for mortgages and for car loans and things like that. And they charge the people they loan the money to more than they pay you. And that difference is their profit on it that they use to run their general expenses of their company.
Oh, interesting.
Yep.
And I'm wondering if you know, like, on a credit card, because that's where you'd be paying an APR interest rate, right?
Correct.
Do we know what a typical rate would be like for that?
Well, credit cards are the highest rates generally that you're going to get. They're upwards of 29%. That's why you want to avoid having a balance on a credit card that you're trying to pay down over time, because that interest rate is so high, it will take forever to pay down what you owe.
Yeah, that's
all you can afford to pay is the interest.
So it's like the most. But does it cause a problem if you are paying it off on time?
Well, what is on time? So
monthly?
if you're think of it this way: you have to pay 30% of the balance every month just to pay the interest. So if you're planning to have it for a year or 2 years, you got to pay a lot more than 30% of that balance just to cover the interest on it. So
it's not good for big purchases
that's
that
terrible.
You can't afford up front. But
terrible.
If you're making small purchases, your everyday life, groceries, whatever, that you know you have enough money to pay back at the end of the month.
It's fine.
Then it's fine.
It's fine.
Okay.
Because you
That's
don't pay interest if you pay it off within 30 days.
Nice.
So, if you pay it off before your next billing period, you don't pay any interest on it. The bank gets about 3% or so from the vendor that sold you those goods. And that's how they make their money. So think of it. They get 3% a month on everything that goes in. They make 36% a month on all the money that goes out.
Wow.
I'm sorry, a year on all the money that goes out. You know, that's why credit card companies do very, very well.
Okay.
And generally speaking, they make a lot of money.
So that's a little bit on APR and APY. And if you want more information about credit cards specifically, we do have a whole video on that. So go check that out. Hope this helped you out. And don't forget to like, comment, and subscribe. And we'll see you next time.